If you are a trader or an investor, you need to have a profound knowledge about financial chart as well as up to date with policies, news and market conditions. This video is about chart analysis in which I am going to discuss about how to analyze the charts for trading and investing using price action. When I started, I had no knowledge. I searched on internet and read a lot of books on CPR, price action indicator and so on. If you also want to read them, then the link is in description below. Books did help me a lot in understanding the charts and I was profitable for a while, but still lacked something and my trading was going wrong because of some or other reason. Well, I'm not promoting, but later I myself joined trading classes. And my personal suggestion is if nothing is working for you, then without any second thought, join trading classes. I am sure that will help you. But I am also going to share important things that I wish I would have known at that time. Let's start with the candlestick. This is the most basic as well as most important thing to know. When you see a candlestick chart, you will find a green or red rectangular box with a tail in either direction. Candlesticks are popular and widely used method for visual representing the price movement and pattern on a price chart. They provide a valuable information about opening, closing, high and low prices of financial instrument within a specific period of time. The main component of the candlesticks are body and the wings. The body represents the price range between the opening and the closing prices, while the wicks indicate high and low prices reached during that period of time. Traditionally, green or white candlestick indicate a bullish or a positive price movement, where closing price is higher than opening price. On the other hand, red or black candlestick indicate a bearish or a negative price movement, where the closing price is lower than the opening price. This is a trading view platform which we are seeing right now, and in this platform we are going to discuss about the candlesticks concept. As you can see that these are all the green candles which you see in this chart are bullish candle which represent a positive price movement. All the red candles which you see in this graph are bearish candles, which means that this represent a negative price movement. This is Nifty 50 index chart. You can use any chart which you prefer, and this is 1 hour time frame. The time frame also can be chosen by you, whichever you are comfortable with. So for this example, I am going to use 1 hour time frame. Suppose market opens at 18,600. This is the price where it opens, 18,600. After that, lot of sellers execute their sell positions and the price drops. Let's say price drops to 18,300. This is our opening price at which the market opens, that is 18,600, and this is the lowest price at which the market has gone up to now in 1 hour time duration. After that, a buying pressure appears. Lot of buyers are shown their interest in buying this at 18,300, which results in increase in price, and this price goes up to 18,500 in 1 hour. So this is our opening price, 18,600. 18,500 is our closing price, and this is the lowest price that market had gone in 1 hour. I can visually represent this whole thing in a different way also, like this. This is the opening price, 18,600, and this is the closing price, 18,500. After that, the market has gone up to 18,500 to 18,300. So this is our wink, this is our body, and this is whole thing is candlesticks which we were talking about. The same concept is applicable on bullish candle also. This is a bearish candle. This same candle, see, this same concept is applicable on the bullish candle also. So let's say the market opens around 18,500 in 1 hour time duration. After that, the market goes up due to the very high buying pressure. It goes up to 18,600, 81. Then sellers are very interested in this price and they start selling, and the price drops from 18,680 to 18,400. In this whole process, again buyers start buying and the prices start increasing, which result in recovery in the prices, and the prices in 1 hour time duration reached around 18,620, and the market closed here, right? I made this thing a little bit complicated so you can better understand that whatever happened in 1 hour duration, only that matters, right? This candle has a limitation. It doesn't tell you what actually happened in 1 hour duration. It only tells you closing price, the opening price, and the maximum low or high that candle has made, not the whole process, how much the price has moved in between them. So this is a very important thing to note that. So how I'm going to make this candle? Let's see. This is our opening price, right? 18,600 is our closing price. How high the market has gone? That is 18,675. This is the highest price that market has gone up to, and the how low the market has gone, and that is 18,400. This is the lowest price that market has gone. And since its opening price is lower than its closing price, so the color of the candle will be green, or you can actually say the price are actually rising. Well, there are many candlesticks pattern associated with it, which tells the situation of market and signifies the reversal or continuation of the market movement. These are the few of them which I just discussed with you, but I am not going to discuss all of them in this video because this video is all about the price action. For the candlesticks, I am going to make a separate video which will be in depth and which will tell everything about the candlesticks. But this is a general idea about the candlesticks. Since we have a basic knowledge about the candlesticks, we can move further with the price action. Price action trading refers as a movement and the behavior of a price in a financial instrument such as stocks, currencies, commodities on price action chart over fixed interval of time. Candlestick theory, which we just discussed before, is a part of a price action trading. With the price action, we can trade in any market because the price action work on human psychology of buying and selling, as we going to discuss in coming topics. Suppose we go out in the market to buy fruits and we go to a shopkeeper and ask fruits price. Then he will tell us the current market price of that fruit. As we know from our memory that the most traded low price of that fruit, and we ask for that low price from the shopkeeper. If the fruit is in demand, then he will refuse to sell at that low price. And if no one is buying that fruit, then he will sell it at that low price. Same goes for the financial market. Charts are the memory of the financial transaction of a big investor, and shopkeeper is a big investor ready to sell its investment to another big investor. The person who willing to buy that fruit is a buyer. The most traded price is support for the buyer and the resistance for the seller. So our current topic is support and resistance. In this example, the buyer is not willing to buy the fruit more than the price where they traded the most. For the seller, he willing to give a discount up to that most traded price. Let's understand support and resistance through charts and how are you going to use it in your trading. So it is very important to understand first what is the support and resistance and how are you going to identify them in this chart. In our example of shopkeeper, we already discussed what is support and resistance. Support and resistance is the most traded price in the market. So if we apply that thing on this chart, we will able to come to know what are our support and resistance. Before I go into the charts, let me bring one thing in your notice that support and resistance is not a simple single price It is a range of price in which the market is trading. So if we consider the range, our first support and resistance is this one. This is a range in which the prices traded the most. So let's take an example, and with that example let's understand the concept behind support and resistance. Let's say this is a chart for iPhone prices. Okay, iPhone. So this iPhone is selling in the market between these two range, from 10,919 to 11,621. When there is an increase in demand, but the demand is not so high that it outmatch the iPhone available in the market, then the prices goes up, but they are not able to cross this zone. As you can see here in this chart, the prices goes up because of demand, but the demand is not so high, so the price is unable to cross this price of 11,621. After some time the prices came back down as the demand goes down. When the prices of iPhone touch 10,919, so from their previous memory, the buyers come to realize that this is the lowest discount the iPhone has given them last time. When the prices drop again at this time, at this price, there is a lot of buyers sitting over here and they are willing to buy the iPhone at this discounted price. Because there is a lot of buyers and they are willing to buy iPhone at this price, the prices shot very aggressively and they even crossed the high of this price range, that is 11,621, and start trading at higher prices, that is 12,022, from 11,621 to 12,022, and create this new support and resistance zone. Same concept applicable in this zone also. Whenever the prices are coming near 11,621, there are buyers sitting over here that they are willing to buy the iPhone at this price. 11,621 is the discounted price for them, since they were unable to buy the iPhone in this range of 10,919 to 11,621. So whenever the price drops around here, they start buying. Whenever the price drop here, they start buying. And at some point, the quantity of iPhone that is available in the market is not enough, and the buyers are even more now. So the price shoot from this zone also very aggressively and make a new high into this zone of 13,084. So this is how human psychology works, and this is how the support and resistance work in charts. You can apply this thing on any charts and on any time frame, and this is going to be very helpful to you in trading and in investing. Breakout patterns. Breakout patterns in chart refers to a specific formation or configuration that occurs when the price of an asset breaks through a significant level of support or resistance. These patterns can provide insights of potential price movements and help trader identify trading opportunities. Some common breakout patterns you may come across in the chart are triangle breakout, head and shoulder breakout, double top, double bottom breakout, triangular breakout, and cup and handle breakout. These are few examples of breakout pattern commonly observed in charts. It's important to note that the breakout pattern should not be considered in isolation and should be confirmed by another technical indicator or analysis techniques. Additionally, it is crucial to consider the overall market conditions and Use proper risk management strategies when trading based on breakout patterns. Let's understand the states of market. There are basically three states of market, or you can say phases of market. First one is a trending market. Trending market could be a downtrend market or could be a uptrend market. As you can see, in this the price is continuously going up. So this is a basically a trending market. This whole thing is trending market. Second one is sideways market. In the sideways market, the prices are basically are into range. They continuously trade between range. So you can see here, this is a range bound market, as you can also say range market. This is also one phase of the market. The other one is a channel. In this market is actually trendy, but it doesn't respect SNRs and a support and resistance. As you can see in this example also, the market is basically going down. It is going down, but it doesn't respect the support and resistance. So this is a channel type market. This is a sideways market and this is a trendy market. Let's understand trending market. So in the trending market, the prices moves in a one direction and they respects SNRs. There are two type of trending market which is you can see in this chart. One is a bearish trending market, something like this. The other one is bullish trending market. There is not a particular pattern that I'm showing. It is that mostly this type of fall doesn't happen in the market. It only happens when a negative or very powerful negative news happen in the market. Then only such kind of move you will be able to see in the market. So this is a news affected graph. But later on when you see the recovery is very slow and mostly the market moves in this manner only. So let's understand how the trending market moves. As we already discussed about the SNR, so I'm going quickly identifying the SNRs. I am just talking about this portion of the chart only. As we already discussed about the SNRs and how they actually works and what is the concept is, there is a huge fall in the prices of Nifty 50 and I'm using a 1 day time frame. After that, the market start recovering and a very huge buyers actually investing, which results in the increase in the prices. Later on, at this zone, this SNR, as the buyers are more interested in buying, so the prices actually rised and gone up. Some of the buyers or investors book their profit. That is why there is some sell-off, which you can see. Because of that sell-off, the prices goes down and they took the support of this level, right? 9,577. The moment they touch this zone, the buyers again start aggressively buying and the prices abruptly move up. Some of the people again book their profits and which result in a little bit price decrease. And as the price goes down, again the price are taking support on this zone and the buyers actually buying it whenever the prices come down. When there are more buyers which are interested in buying Nifty 50, which again result in price rise. So this whole thing actually happens in the market when there is a trending market, when there are one side buyer or a seller are more in the quantity, which actually moves the price in one direction. The prices do not move in a straight line like this. The prices always moves in this pattern. Always taking support and then again move up. This is how a trending market moves in one direction. So let's understand channels. What are channels? So this is one example in the Nifty 50 index 1 hour time frame and that I could find, and you will understand how the channels are. Channels are basically one way direction price movement, but they do not respect SNRs. Okay, this is channel. As you can see, the markets are dropping, right? This is a SNR for sellers. When the market drops, this become a resistance for sellers. After that, the sellers actually push the market and downside, able to make new lower low. But they do not respect its support. They come very deep, then again goes down and almost make a new lower low. See, this is level and this is this level. So they are able to make a new lower low and again goes up. So basically they are not respecting this SNR also. Again the seller push down the prices and they make new lower low. Again the prices move up. They almost make same height of prices that they made last time. This is the channel. But the one thing that you need to understand when you are comparing it with the directional move and range. In a directional move, the SNRs are actually being respected, uptrend or downtrend. And when you're comparing it with the in the sideways market, the higher highs are almost at the same levels and lower lows are also at the same levels. This is the main difference between a range market and a channel, that they have a same level of higher highs and lower lows. There is no respect for the SNR, same as channels, and that's it. And there is one more thing that I like to tell you before we move to the range markets, sideways markets, and that is the channels are the indication of weakness in the market. They are having a very hard time in pushing the market in downside because the buyers are able to push the market upside in very deep into the SNRs. Very deep into the SNRs, buyers are able to push the market. Whenever the channels are forms, either in the uptrend or in a downtrend, this indicates there is a weakness in the movement and anytime that direction could change. This is a signal for the trend reversal also, because after the channel, the range market come into existence because the buyers are basically start building up their positions and the sellers are losing out. There are much more less sellers available in the market to push the prices downward, and there are much more buyers available in the market to push the market in upward. As you can see, right now Nifty 50 is in uptrend and properly taking support, even almost reached at the same height when the Nifty 50 made his previous high. So after channel, there is a formation of range market. This is very important thing that you need to know. And the range market is a build-up market in which the big investors are actually building up their positions. So let's talk about range markets. The next topic is sideways or range type of market. So as you can see in the chart of Nifty 50 1 hour, that this is how a range market look like. The prices react in the range and the higher highs are at the same level and lower lows are also at the same levels, as you can see in this graph. So let's understand why this kind of range appears in the market. And this is very important because one of the reason is that there is a no huge investor available in the market, and only retail investors are only available in the market, and they are, since they do not have that amount of investment available to them, so they are unable to move the prices in one direction. Let's understand with an example so you can better understand why the range are very important to us rather than a trend market or a downtrend market for the trading. Let's suppose there is an X investor available to us, and he got a very lot of money with him, and he want to invest that amount of money in crores and crores amount of money into Nifty 50. But the problem is he cannot directly put his money into the Nifty 50 in one order, because if he do that, the two things will going to happen. First, when he insert his money here in the market, the prices will shoot and they will go very high. He do not want to buy that high level of prices, first of all things. Second thing, when he put his order into exchange, the most of his order will not be able to execute because the price will rise as the demand increases into the market. If he want to invest 1,000 crore into the market, in spite of investing 1,000 crore, he put a lot of different small orders into the market. So he was able to fill up those orders. So first he will execute one order here, then again he execute another order here. Again, when the price drops, he execute his order here. Again he execute his order here. So he put multiple orders into the market, so he was able to full his all the orders and able to invest 1,000 crores into the market. This is the one important reason why you should know about the ranges. The same thing is true for sellers also. If somebody want to remove his money from the market, he will not be going to execute a single order into one go. He will put a multiple orders into the market. So he was able to execute all his orders, as well as he could average out his prices. So he could book a maximum amount of profit that could possible. And why ranges are important to us? Because this is the perfect place to enter into market or exit into market, because the investors are also, the big investor is also filling his position or removing his position into this ranges. Whatever a big investor is doing, we should do the same, because he is the one who is actually moving the markets. This is a very important thing that you should know, that you should always enter into a range market or exit into the range market, depend upon your analysis. All right, our next topic is indicators. I'm not going to discuss all the indicators that are available into the trading view or into the market. I'm only going to discuss the indicators which I use, and I'm going to show you and what are the significance for those indicators to use in the market, and how I use them. The first one is a volume indicator. As you can see, this is the volume indicator, and it shows how much volume actually is in the bank nifty, because I'm actually watching the bank nifty index future of 15 minutes chart. This actually shows you how much volume is there in the market or into that candle, is how much trading is being done, buying and selling is being done. If it is very active, then there is a huge amount of volume that you will able to see. Suppose if we talk about this portion, and in this portion you can see there is a huge volume is available to there, and after that you can see that huge buying and selling is being done in the market. The price actually goes up from that place. As you can see, there is a volume and the prices goes up. The volume actually doesn't shows you that the price is going to go up or down. This will tell you the big investor is actually investing into the market. And whenever the big investor is very keen to invest into the market or want to remove the investment from the market, it will naturally going to affect the prices into the market, and in this case, the bank nifty. If there is a huge volume of buyers you see in this indicator, then there is a very high chances that somebody is buying the bank nifty, and there is a very high possibility that the prices will react to it and they will go up. There is a huge volume of buyers, so this actually results in movement upward movement into the prices. There are a lot of things that you need to know before you use a volume indicator. First of all, that in which time frame you are using it is very important. Which time frame you are trading into, it is very important, because if you are trading into 3 minutes or 15 minutes, then always stick to that time frame. This will help you to trade properly and actually become a profitable trader. Okay, let's move on to our next indicator is a pivot point indicator, and this indicator helps me to identify the resistance level and support level. Whenever I am little bit confused, I actually go to this pivot point and see what are the levels are actually there, and this give me a little bit help. I do not use this indicator into the trading, and I usually do not see all the levels, because all levels are not that important, because most of the time market actually do not react to those levels. And as you can see, there are resistance level R1, R2, R3, R4, R5, support levels S1, S2, S3, S4, and there is a pivot point. So all these levels that you see into the live market are being calculated from the formula previous days levels of pivot point, resistance, high and low, and everything. So if you want to see the formula, I will just show you the formula, but it is not that very important. How I actually identify the important labels is that I see the last 2 or 3 days levels. Suppose let's take this an example. This is a R2 resistance level 2 that is being made by this indicator. And if I want to see this level R2 level is very strong or not, then I go previous day or day before that and see is there any zone or a label is there or not. If it is there, then this will give you a quick idea that this level is very strong. As you can see in the video, a strong zone. And as you can also see that market is actually having trouble in crossing this zone also. So this is how I use this indicator. Not much to get. EMA indicator is used by a lot of people, and most of them actually use it for the trading, but I do not use it for the trading. I only use it to see that what is an average price of where the market actually can react from, because most investors or buyers actually want to buy as low as possible, and this indicator actually helped me to identify that average prices in the time frame which I'm using. And that's all there is, but I do not use it for the trading. So I use three EMAs, and the EMAs are basically are the averages of candles. So if it is a 220 EMA, then that means that it is taking average of 20 candles. If it is 50 EMA, then it is taking average of 50 candles. So this give me a perspective that what is an average price in the time frame in which I am trading. So if the market reach almost at the average price, then there is a huge chances that the buyer will show their interest into it, and the prices could go upward. Or if the EMA is very low and the prices are very high, then there is a very high chances that the seller will start selling aggressively and the prices will move down. This give me just a basic idea of trading. So these are the three AMS, and that I basically use, and that's it. Move on to the examples, And in those examples, I am going to read the chart and analyze the charts. And I think that will be very helpful for you to actually understand how actually we should read the charts and understand the price action trade into the markets. In this example, we will see how the market is actually reacting and what are the places that you could actually enter and have a little bit of profit from this range bound market. So I'm not going to show you the charts, and I am requesting that you also use your technical knowledge to actually analyze the chart which I'm going to show to you. And you can ask those questions in the description if you want, and we can discuss on that also. As you can see, the buyers are very aggressive and they are buying a lot. So if we move our, we can see that in the next day, the market actually opened with gap up. So there are something which I like to tell you about the gap ups and gap downs is that the gap ups and gap downs are a good support and resistance. Not only that, the market actually tries to fill up those gaps. So when the market actually opens with a gap up, in this case, prices actually come down and try to fill up this gap. Since the buyers are very aggressive, as you can see here, they quickly bought Nifty 50 and the prices goes up. So both things which I told you just now actually fit here perfectly. The market tried to fill up the gap, but this gap is act as a support as well as resistance. So the buyers take the support here and they push the price upward. Let's move on further. You can see the another gap up, but there is a slowdown in the market. Actually, the market is actually holding it. It's not going down, it's not going up, it's actually holding that zone. Then next day, the market actually comes down and try to fill up the gap. There's one more thing that you need to know about is that the last day closing price or the last day high or low prices are very important because those could actually also act as a support and resistance for the current market. So in this case, as you can see in the charts, the day before previous day, the closing of the market is around these levels, and the, as you can see, the current market is also taking support around these levels also. So before moving any further, let me give you another support and level which actually I showed you here. With our definition, the most previous traded zone is the support and resistance level. This is also SNR, right? But if you are going to ask me that that what the definition which I told you in the video is not actually compatible with the one I am right now, that the gap ups and gap downs are support and resistance, and the closing and high or low of a previous day is also act as a support and resistance. The thing is that when I told you that the most traded price, previous traded price is a support and resistance, because that price is in your memory and that is significant enough to make you remember that those prices, right? So as long as that significance of remembering the prices is there, the prices will react from that level. So the previous day high is a significant memory that people actually remember. A gap ups or a gap down is a significant memory that people actually remembers. Being said that, let's move on with our chart. The day before previous day closing is actually acting as a support for the buyers, and the buyers are actually hitting very aggressively, as you can see here. The two candles that made are very big. There is a momentum into the candles. Still, I do not tell you to enter into this market because there are chances that market could react from this place, since this is also a support and resistance. So moving on further, see the market actually goes up. You can cross the SNRs without any difficulty. Let's move on further. Prices actually came down very deep, as you can see. If I was watching this trade and was thinking of buying this trade, then there are two places that I could actually think of entering. One is here to those zones. Whenever the price drop to this zone, I will actually with a stop loss, obviously. And the other zone that I'm actually intended to plan is these levels, because the market actually being held by these levels and it is pushed up very high. So this level is also one of the important level for me to enter into a trade. Then move, the prices actually came down even to these levels again, and after that short very very aggressively. Now if we see even further, okay, so the market is actually now is not moving that aggressively as it was moving here, right? And it came back almost, it came down very deep. So the movement is actually being held by this zone. So I can actually, like this, there a seller is actually sitting over here, which is selling whenever the price actually comes to him. So I should be very careful with this zone when I am thinking about trading. So the my now as you can see, the market is actually holding. Let's move further and see what actually the market is doing. Nifty is doing. Came back again, try to make higher high, but it fails and it actually holds the position for quite a duration. So this is our range. When I told you that the range is good place to enter and it is a good place to exit, right? The prices actually holding these levels very perfectly. Now you can see this SNR, this zone is actually acting as a support level for buyers. And whenever the price is actually entering into this zone, the buyers actually start buying and the prices goes up. Moving on further, as you can see, the prices actually goes high enough to cross this SNR. This most traded price actually is here and previous 2 days high. So this is very strong SNR, which is broken by the buyers with a quite moment with a very big candle. If I see one more thing, then I can see that there is a volume also. There is an increase in volume. There is a huge volume on this candle. But after that, if I see that there is no volume, only single candle volume is there. Usually, I like to see the increment in the volume. Right, I was not able to see here. There are very high possibility that market will not go very high and it will come back. So I will wait for the pullback, but I will not be very keen for the trade. I will wait and watch. And if you are thinking about the pivot point, then we can actually see the pivot point also in the indicator. That could also signifies that this level is very strong with R2 and there is another level R1. The current day has a resistance level of R1 and this is a resistance level of R2. Let's close this. And if you want to see the average EMA, then the prices around here is actually very good for buying also. So let's move on further and see the prices actually pull back. If I make this candle, then I see there is a body up to here and this whole thing is a rejection. The market actually came down very sharply in one candle itself. The market pullback, the pullback should be very slow and with wicks. So there are very high chances that that pullback that is a pullback and but since in this case the pullback is very short and with a single candle it almost completely bring the market into same zone, same SNR zone. Moving on further, as you can see, Nifty 50 actually came very deep, even crossed the SNR. So our next SNR is here, which actually being respected by 2 or 3 times. That one is also being crossed by sellers. This give us a signal that the sellers are now very strong and very aggressive with the selling. as well as you can see here that the selling volume is also very high in two or three candles. So you should be very careful. Moving on further, you can see this zone is still being respected, right? The prices actually came down and the buyers enter and they push the market to push the prices little bit higher. This zone is actually being holding. One more thing that I like to tell you that sometime when you draw an SNI zone, there are chances that the market actually crossed that zone and then again it came back in. There are cases and market actually act that this way also. So you do not need to be very specific about that key market actually crossed your SNR, so the SNR is not basically holding it, because sometimes market actually crossed the SNR but it came back in. Moving on further, the market actually come down and took support at this level. From here to here there is a no trade zone. You cannot trade this sell. If you try to trade in this zone, there is a high possibility that you could make loss, because we do not know how the market will react. Here also there is volume for the seller. I am not ready for the buy yet. Okay, if we move further, the buyers actually start gaining and the prices actually rose. Now up till here we do not know what the market is actually doing. Now we have enough information to understand what is actually market is doing, right? If we see this whole zone, we come to understand that the market is basically into a range bound, and there are some sellers sitting over here. There are sellers sitting over here and they are selling aggressively, as you can see from this sell, and there is a volume to justify. So when the market is actually coming here, you can actually sell it from here, though I do not advise you, because we are in the buyer's market, right? As you can see, actually slowing down here at when it reaches the zone, but there are possibility that market could actually go and cross this SNR also. So we have to see and confirm that it is actually holding. So market actually came down and start going up. Now it is clear that actually it is making lower low. This high is lower than this high. So you can say that the actually market is going downside. You can actually enter in this zone also. You can actually enter into this zone also, but you should not be very aggressive with yourselves, because from the fact we know that this is a very strong support level where the market actually holds three times. And so my advice would be that you should take this SNR, because it this SNR make the prices react to it. So we can actually book our profit from here. And as we see, the prices goes down and the market actually reacted to these prices, and after that the buyers actually took the market up. So in spite of trading on the sell side, it is better to trade on the buy side. Okay, so when the market actually crashing down from here, and we already seen three times the market actually reacting in this zone, so we can actually enter here, and you can clearly see that market actually gap up two times and gone up. So this is example one. So this is how you should read your chart and analyze your chart. Trade should be in line with the trend. So if you want to actually see which side you should trade, then you should always go one time higher to understand that. Suppose I'm trading in 1 hour, then I should go to the 4 hour and see what is the trend of the market. So as you can see, the market is basically bullish. It is moving in up direction. your trades should be aligned according to your trend. Then only there is a high chance that you are going to make profit. So this is our example number 2. In the previous example, in the last, I told you that we should always align to the trend, and you can find trend by one time frame above your current time frame. So in this case, I'm actually trading in Bank Nifty 15 minutes chart, and our one time frame above, that is 1 hour, shows that our trend is basically in buy side, right? So I am going to show you how you should actually analyze your chart when you are dealing with this situation, that your trend higher time frame trend is in the opposite with your current time frame trend. So in this case, the one point that you should always know, that when you are trading into any time frame, that time frame trend is important. So in the current time frame trend, our trend is basically in bearish side, right? Before we move further, let's analyze our SNR. There is one SNR over here, SNR zone, which is most traded price. Other one is here, and one very important one that I like to tell you is this: our most important SNR is here, because this zone is being traded. This zone is basically traded a lot of time. So this is our important zone, and it is very strong zone because it is traded for a very long interval of time. So it is very strong SNR that you should keep into mind. I'm not actually drawing the whole zone. I'm just taking, I'm just drawing the upper side of that SNR where the trade are maximum being conducted. So let's understand this chart. As you can see, the prices actually goes down, and this is the second SNR, this is the first SNR of that downtrend. As the market goes down and they start holding, because it actually reached into a very strong SNR, the prices are actually slowing down. So there are actually a lot of buyers sitting over here, and they are willing to buy these prices. There are buyers sitting over here, and they are willing to buy these prices. So that is the reason why the prices are basically, they are having a lot of tails in at the end of each candle. From there you can actually analyze that they're actually having trouble in going down. And as you move further, you can see the prices are actually holding, and since the buyers are there and they are actually buying, which result in prices goes up. The prices actually reach to the SNR, and this is our SNR. This is our SNR, and the prices actually goes up and took support at that SNR. Prices hold for a while over there. Since our current trend is bearish, so there is a very high possibility when the market is actually holding like this to come down from this zone, because there are two SNRs, one this one and other one this big one SNR, in which the market actually hold for a very long interval of time. So when the market is actually struggling like that and it's not going up, then there is a very high possibility that market actually goes down. So as you can see, the market actually came down very deep. We can actually take this level also one of the SNR. We can take this level also as an SNR, because here our prices actually trade for a good interval of time. This is another SNR, and as the prices goes down and actually cross this SNR without much reacting to it, but our main SNR is here. This is our main SNR, right? Where the actually prices reacted from it and they came back in. the because of SNR, the buyers start buying here. Now the prices goes down even deeper than this zone. The buyers are even more interested from buying because this is inside the SNR zone, and you can see the prices are actually going up. Prices again react from this SNR because there are sellers sitting over here and they are willing to sell from this zone because for them this is their support level. So they sell from this SNR. This is their support level, and the prices actually drops. Now actually the market is in range bound. As you can see, the market is basically into the range from this zone to this zone. Sellers are here. Sellers are basically aggressively selling, and the buyers are basically aggressively buying. There is one point that you always know that your current trend is bearish, but your bigger time frame is bullish. One time frame bigger is bullish. So when it comes to the winner, your bigger time frame is always going to win the battle. So that is the reason why I told you, when you are going to trade, you should always trade in align with your one time frame, higher time frame. You should always trade from the buy side because there are very high chances that those buys could actually work and they actually give you much better profit. You could actually also trade from the your current trend. There is no problem with that. As you can see, the your current trend is in bearish and actually giving you some profit over here and some profit over here. This is our example number 2. I hope you will understand what I want to tell you in the example number 2. So this is it for the price action video and chart analysis. I hope you like this video, and for such kind of video, please stay tuned. And I'm going to make more chart analysis video in our channel. So you can subscribe to my channel and see more such kind of videos.